Hello, everyone, and welcome back to this webinar series, Capital Market and Development. So today's topic is hidden non-performing loans in China. The speaker is Tianyue Yuan from National University of Singapore, and our discussant is Chang-Tai from Chicago booth. So Tianyue, the floor is yours. You have 25 minutes.
Thank you very much for this opportunity to present this paper in this wonderful platform. This is joint work with CHAROENWONG, who is also from NUS, as well as Meng from Renmin University of China. We are very grateful for this opportunity, and we also thank the organizers to ask Chang-Tai to discuss our paper. So this paper is concerned with the resolution of non-performing loans, NPLs, or troubled banking assets more generally. We know that bank distress can lead to systemic financial and economic crisis, and a widely used approach to clean up troubled banks is to set up a designated entity such as an asset management company or AMC that is tasked to take over the troubled assets from these troubled banks and resolve them outside of the banking sector. These type of AMCs were first used in the late 1980s and early 1990s in the US and Sweden. And since then, it has been used in many countries across the globe to resolve troubled banks. More recently, the European Commission and the Indian government are the two governments that lean in this approach, given the expected rise of NPLs in a COVID pandemic. However, despite the various buy-ins from policymakers and governments, we actually know very little of how AMCs work, mainly due to the lack of data for us researchers to actually examine them. So in this paper, we hope that we can open up this black box at least a little bit by using China as the empirical setting. So AMCs have been used extensively in China, dating back at least 2 decades. So in the late 1990s, 4 national AMCs were created. They were deployed to clean up the big 4 national banks in the late 1990s and early 2000s. Since 2012, a new type of AMCs, namely the local AMCs, could be established as the designated institutions to acquire NPLs from banks and resolve them outside of the banking sector. Under the new regime, banks face very little restrictions on offloading NPLs through these AMCs. And therefore, we see a very widespread use of this offloading opportunity among banks, big or small. So we argue that compared to many other countries which had a more targeted and short-term uses of AMCs, China's setting permits us to conduct both time series and cross-sectional analysis of the AMC model. So in this paper, our research questions are twofold. First, we want to empirically evaluate how AMCs performs. Do the NPO transactions they conduct reflect orderly resolution of troubled assets as their objectives are? And associatedly, what are the implications for financial stability? Our finding is that by and large, the NPO transactions appear to be concealment rather than orderly resolution. An implication of this is that although banks remove NPLs from their books, they still remain exposed to the risks of these NPLs. Recognizing the hidden NPLs implies that the true NPLs are understated by 2 to 4 times. We speak and contribute to the literature on problem loans, creation of designated resolution entities, and more generally, the literature on regulatory arbitrage and the effectiveness of financial regulation. So now let me briefly describe the institutional setting. So as I have mentioned, AMCs have been used dating back 2 decades, starting from the 4 national AMCs. So in 2012, China's Ministry of Finance and the China Banking Regulatory Commission, which is the top banking regulator in China, launched a new initiative that allow the establishment of local AMCs to acquire NPLs from banks. What happens here is that banks, they package their NPLs and then transfer these packages to the local AMCs. From the bank's perspective, This transfer is deemed as disposal, and therefore they can remove the transfer NPLs from the books. All banks have access to this disposal opportunity, and therefore we see widespread use by both large and small banks. By the end of 2019, 59 local AMCs were set up. In this paper, we primarily use a proprietary data set obtained from a large leading local AMC. We observe all the NPL transactions this AMC has ever conducted since its establishment in the fourth quarter of 2014 all the way through the end of 2019. In our sample, we observe 82 banks transfer NPLs to these AMC, which is quite balanced in the size distribution. So we have included in our sample all 4 of the big 4 state-owned commercial banks. And when we move to the next tier of banks, which are joint stock banks that are smaller than the big 4, but still have national presence, we observe 8 out of the 12 joint stock banks. And we also observe 70 smaller regional banks in our sample. And in terms of where the banks are located, we also have a pretty balanced geographic distribution of their headquarters. 7 banks located in Tier 1 city, 12 headquartered in Tier 2 cities, and 63 banks in other places. So in order to evaluate the nature of the MPO transactions, we consider 3 plausible scenarios. The first one is what we call orderly market-based resolution, where we think the market or the invisible hand is at work. So in this scenario, AMCs acquire NPLs from banks at the risk-justified prices and work to resolve the NPLs. So in this scenario, the market mechanism for price discovery is at work. And we know that this is also the intended objective of the 2012 deregulation that paved ways for the AMCs. What happened in this scenario is that the risks associated with the NPLs are transferred from banks to the AMCs and potentially to other market participants if the AMC later use auctions and other methods to resolve these NPLs. The second scenario is a government-backed resolution, where basically the AMCs act as agents of the governments to bail out the troubled banks. In this form of government bailout, the risks are again transferred from the banks to the AMCs and later could be transferred to other government entities. Conversely, there's a concealment hypothesis where banks devise strategies to conceal their NPLs without proper resolution. So this is a form of a regulatory arbitrage where risks of NPLs do not get resolved and banks retain risk exposures to the NPLs. So these 3 scenarios, they would have different empirical predictions for different aspects of the NPL transactions. So we summarize them here, and we are going to take a look at each of these aspects one by one in the next 10 minutes or so. So the first aspect is the NPL transaction price, namely the price that the AMC pays to the bank when the AMC takes over the NPL package from the bank. We think that in the orderly market-based resolution, risk-based pricing should be at work. So haircut would be large for non-performing loans, and haircut should reflect credit risk. In the other 2 scenarios, the transaction price may be higher than the risk-justified prices due to either government guarantee or government subsidy in a government-backed resolution, or just private negotiations or coordination between banks and AMCs in a concealment. So what does the transaction price look like? So here's the summary statistics of the NPL transactions. So each of these packages has an average size of 642 million yuan, which consists of more than 100 loans from 87 borrowers. The average delinquency of this NPL package is over 4 years. However, given in view of the very high delinquency, the transaction price is rather high. When we calculate the haircut of the transaction price relative to the face value, we find that the haircut had a median of 0% and a mean of 5.1%. So we want to highlight that such a haircut is very, very low. If we compare to other haircuts we observe in distressed credit asset sales. So for instance, a small portion of NPLs have been auctioned in Taobao. In that setting, we observe an average haircut of 20 to 60%. And in the US, banks routinely sell past due credit card loans and mortgages and so on and so forth. They are close to 90 days past due. And the haircut observed there is about 40 to 90%. And also, we want to highlight that in the 1990s, Japan had used the AMC model as well. So based on the analysis of that episode, NPLs backed by real estate had an average haircut of 62%. So compared to these other numbers of haircut, we can see that haircut here is rather low. And when we plot the empirical CDF of the haircut, we can see that about 60% of the transactions had zero haircut. They are sold exactly at a face value. Some transactions even had a premium, so they are sold above the face value. Only less than 3% of the transactions had a haircut greater than 30%. When we look at what correlates with the haircut, we find that haircut does not seem to reflect credit risk. So for instance, we actually see that the longer the NPLs in the package have been delinquent, the lower the haircut, which is completely opposite of risk-based pricing. We also see that healthier banks characterized by higher capital ratio had a higher haircut. So to sum up, we find strong evidence that risk-based pricing is unlikely to work here, as most transactions have zero haircut, some even a premium, and haircut does not increase with delinquency. So these findings means that the orderly market-based resolution is unlikely to be at play, which leave the other two predictions, the government-backed resolution and concealment, as plausible explanations. So next, we want to look at who services the NPLs and who supplies funds for the AMCs to take over the NPL in the first place. In the two resolution scenarios, we think that AMC should be driving, since they are either they are the representative or the entities that does the resolution. Whereas in a consumer hypothesis, banks may be driving because they are active in concealing the NPLs. So we find that according to the AMC, it receives funding for 100% of the times from the originating banks. So it receives funding from the banks to take over the NPLs from the same banks. And also in all the transaction contracts, there's a term that delegates the collection of obligation back to the banks. So although banks have removed NPLs from the books, they retain the obligation to collect and manage these non-performing loans. So in terms of funding source, we actually see a change after a July 2019 regulator's ruling that bans direct loans from banks to the AMCs as a means to finance the NPL transactions. Before July 2019, we observed that close to 70% of the transactions receive a direct loan from the same originating banks to take over the NPLs. The other 27% also receive funding from the bank, but through an indirect method, through another intermediary, such as a trust company or securities company. After July 2019, since the direct loans is forbidden by the regulator, it ceased to exist. But we see that the majority of the transactions just shift to the very specific indirect financing or bridge financing from these other intermediaries. So we can actually study the choice between direct loan and indirect financing in the July 2019 sample. We find that if we do this by regressing the direct loan shares against bank capital ratios and health measures, we find that unhealthier banks characterized by lower capital ratio and higher incidences of violating a loan quality regulation tend to use direct loans more. So we interpret this as they are more desperate in offloading the NPLs, and therefore they resort to direct loans as a way to facilitate and expedite the offloading. So let me summarize here. So in the aspects of debt collection and source of funding, we find evidence consistent with banks playing a more active role and consistent with concealment. So all transactions delegate the collection obligation back to the bank, and all transactions receive funding from the banks, which respond to these regulators' ruling. So next, I want to talk about what happens to the NPL packages after they arrive at the door of the AMC. So we believe that in the resolution scenarios, the AMCs should work to resolve these NPLs. They may involve other market participants if they later use an auction, or they may involve government entities if it's a government-backed resolution. However, in a concealment scenario, a resolution is actually not part of the picture. So the AMC may just act as a pass-through to just toss the NPL packages to someone else. So in the data, we see that on average, a package stays with the AMC for about 21 months. After that, the majority of them are sold to someone else. So the main buyers of the NPL package in the second sale is a third party, which we would specify and provide more details in in 30 seconds. So, and only 10% of the NPL packages seems to stay with these AMC after 21 months. And I want to point out that in the second sales, there's no further syndication or bundling of the NPLs. These packages are just sold as they are after 21 months. So in the second sale, the transaction price that these AMC receives is always higher than the transaction price it pays in the first sale, resulting in always positive resale premium with a mean of 0.15% and a maximum of 3%. And these third-party borrowers, we find that they're always in the same city as the originating banks. And by and large, they are the existing clients of these banks. So we believe that these third parties, they actually buy the NPL package on behalf of the banks as bank affiliates. So when we look at what correlates with the resale premium, we find that the only thing that loads in this regression is the number of months the NPL stays with the AMC. No other variable seems to load in this analysis of resale premium. When we actually plot the resale premium in the vertical axis against the holding period of the AMC of the NPL package in the horizontal axis, we find that, first of all, the holding period with the AMC is exactly 6, 12, 18, 24, 36 months, as the blue dots line up in this month. And second, resale premium in the unconditional distribution is an increasing function of the holding period, as the black line show here. We believe that the exact clustering of the holding periods in the multiples of 6 months is unlikely to reflect an orderly resolution through auctions, because in that scenario, the holding period would be more evenly distributed in time. So these clustering reflect the coordination between the bank and the AMC ex ante, and as a result, the black line, the increasing relationship between resale premium and the holding period reflect a commission schedule to the AMC. So let me summarize what we find in terms of resales and ultimate ownership of the NPL packages. More than 80% of NPL packages are resold. All the resales have a positive premium, and these likely reflects a compensation schedule for the AMC, and the majority of the third-party buyers in the resales are borrowers and all clients of the banks. So once again, these findings are more consistent with concealment. So lastly, we want to look at the market reactions. So in the two resolution scenarios, since NPLs are removed from the banks and resolved outside of the banks, it's actually good news for the banks. So there should be a positive price response. Whereas in the concealment, the price response may be 0 if it's so secretive, or negative if the market actually knows about this concealment. We find that in the data, in both the stock market in the left panel or the public debt market in the right panel, we do not see any price response. So markets do not react to the MPO transactions. So we find in this last aspect also supporting evidence for the concealment scenario. So all in all, we have examined different aspects of MPO transactions. Although each of these individual observations, you may argue that they may reflect something else other than a concealment explanation. We argue that putting together the combination of these empirical observations are most consistent with the concealment, which points to the following movements of NPLs in China's financial system. Banks, they face regulatory pressure to comply with a quantity-based loan quality regulation, so they have incentives to remove NPLs from their books. How they achieve this is that they use the AMC as a pass-through entity. So they provide the loans to the AMC to purchase these NPLs from themselves, and they also remain obligated to collect these NPLs. AMC is mainly act as a pass-through entity by profiting through the resale premium. And ultimately, a large chunk of the NPLs that were tossed out of the bank's balance sheets end up with these third-party borrowers of the banks who we believe act on behalf of a bank, and they are bank affiliates. So in this process, we can see that NPLs are removed from banks' balance sheets, but they do not seem to be resolved. And this is what we call hidden NPLs. So we want to point out that since the 2012 deregulation of local AMCs, banks actually use this disposal method a lot. In 2019 alone, the banking industry disposed 2.3 trillion yuan of non-performing assets, whereas the end of year reported NPLs on banks' books are 2.41 trillion. So assuming that our data is representative of the whole financial system, we conduct a back of the envelope calculation of total NPLs in a financial system. Assuming that the NPLs takes on average 2 years to resolve, which is a conservative estimate because we do observe that even after 2 years after the initial sale, no NPLs have been resolved. Under this assumption, the hidden NPLs amount to 5.13 trillion as of 2019, which is more than 2 times the reported amount. And you may wonder, what are the consequences of these hidden NPLs? To speak to that, we conduct a very stylized stress testing by analyzing how the losses associated with the hidden NPLs will propagate in the financial system if a loss given default is 80%, which is consistent with prior episodes of AMCs, both in China and Japan. So if loss given default is 80%, the total losses would be distributed among the AMCs as well as the third-party affiliates. So according to our data, we use 70% ratio of loss for third-party affiliates. They bear a little bit more than 3 trillion yuan of losses, and they pass through to the banks because of their close relationships with the banks. Under a pass-through rate of 50%, or we conclude that in this stress scenario, about 7% of the total regulatory capital in the banking sector would be eroded, which drives down the revised capital ratio to 13.6%, which is still above the Basel minimums for capital ratios. But I want to point out that China's debt has been rising. So with the expected slowdown in growth rate going forward, as well as this rising trend of debt, the vulnerabilities built up in the banking sector from these hidden non-performing loans may be more serious a threat to financial stability going forward. So I think I'm running out of time, so let me conclude here. This paper is intended to convey that despite the very good intention to cultivate a market for orderly resolution, unfortunately, we don't find much evidence for the orderly resolution. We find that the majority of transactions we observe likely to be driven by concealment. And as a result, banks still remain exposed to the risks. Recognizing these hidden MPOs is crucial for effective financial stability policies. And also, we want to point out that just setting up a designated resolution entity is unlikely to be enough to achieve resolution. We believe that good governance practices and timely supervisory monitoring would be crucial for achieving resolution. Finally, financial fragility in a large economy such as China can have global implications. So thank you very much for listening to me today, and I look forward to Chang-Tai's discussion. I hope that I'm too out of time at this point.
Oh, no, you did a good job on time controlling. So can you stop sharing? Good, Chang-Tai, please.
Okay, thank you. So great. This is a really fascinating paper. So it's a fascinating paper, and I will also say that it left me puzzled. And so let me just summarize their facts. That their data shows that this local AMC buys loans from banks with a minimal discount. It sells the loans with a small markup. The buyers appear to be mostly customers of the banks, and the argument of the paper is that what the banks are doing is that they're hiding non-performing loans on the balance sheet of some of their customers. So let me ask the following question. So Michael is here, and I saw him discuss this paper a few days ago, so I won't say more about it, and I hope that he will say more. The first question is, the question is, are these really non-performing loans? Which is the point that Michael made. And then Michael showed some evidence that these may not actually be non-performing loans. The related question here is, what exactly are asset management companies doing? They were set up to dispose of non-performing loans, but I think there's a great deal of evidence that a lot of them may not be doing that, or they may not be doing only that. Like, there's a lot of news recently about one of the big four asset management companies, the one that was set up to dispose of, I think it was ICBC's non-performing loans back in the late 1990s. HUARONG, that's the name of it. And the news that's coming out now is that in the last 10 years, they've been doing all sorts of things, and very little of what they have been doing is disposing of non-performing loans. So that's the first question. Are AMCs really AMCs? Are you really AMCs, or are they doing other things? Okay, so let me put that question aside, and I hope that Michael will step in the discussion to say more about this. But let's assume that they really are non-performing loans. Okay, so let's assume that what we're seeing are really non-performing loans. Then it seems to me that one has to answer two questions. The first one, and maybe the first question may seem really naive, but but I am not a banking and a finance guy, so I had to ask this question, which is, what do we want AMCs to do? Like, ideally, what do we want them to be doing, and what effect do we think they will have? And my casual reading of the history is that AMCs are effective when it's associated with two things. It's associated with a shift in the regulatory regime. like, so for example, you think about the big four that were created. The goal there was that this was meant to be part of that shift in the regulatory regulatory regime for Chinese banks. There's an open question of whether there actually was a shift. The second thing is that, you know, in most cases that at least that's come out in the media in the last 20 years, it's been associated with a massive bailout too, right? Then the question is, okay, but that's not what we're talking about here in this case. So the question is, what's the role of an AMC on a regular basis? That is, without any change in the regulation, without any change in what banking regulators are doing, or without a bailout. Suppose that there's no bailout by the government. So the first point, when I just as a naive person, when I think about it, you know, why do you want to remove the non-performing loans from the balance sheet? So if I just I'll just make a very naive analogy. Suppose I bought a house for $1 million and the price of the house fell to $500,000. What difference does it make to my balance sheet whether I keep the house or whether I sell the house for $500,000? Nothing has changed in terms of the value of my net assets. So what real effect does it have? Well, maybe what the story that you can tell is that AMCs have a better technology to dispose of non-performing loans. Maybe that's a story, and that's why you want the banks to dispose of the non-performing loans to the AMC. Maybe I haven't really seen much evidence of this, and then I can tell stories in which it's the banks that have the relationships with their customers. So maybe you could tell the story that they actually are much better placed to resolve the non-performing loan. I don't know, but if that's one story that you could tell, maybe another story that you can tell is that it's important to have the value of the assets of the bank. You want that to be transparent to outside investors, to people from the outside, and that's could be important for some reason, maybe. But then the question is, why do you have you could think about more direct ways of doing this rather than splitting the assets. That is, if you think that the bank is not being very transparent in terms of disclosing which of the loans it has are good loans and which of the loans on its balance sheet are bad loans, why would you think that having them transfer some of the loans is going to make it more transparent? Maybe the story is that it's about a contracting problem, that you need future investors, and then there's something about the contract in which you can't limit the losses, the current losses, with a current investor. So then the future potential investors don't want to invest because they don't want to share the losses with the current investor. So this is all just my naive speculation, but it seems to me that when you want to think about what you want the AMC to be doing, you've got to answer the question of, well, what do you want them to do? What do you want them to do? And then once you have an answer to that question, then you can think about, okay, now how do I want to think about the welfare effect of what you're seeing in this current institutional arrangement? Okay, which I'll get to next. The second crucial question is, who are these buyers? Who are these buyers, and why are they doing what they're doing? Because it seems to make no sense. Somebody were to come to you and to say, I have this non-performing loan, it's worth 50 cents on the dollar, will you give me full face value? And what idiot is going to say, yes, of course, I will give you full face value, right? So it makes no sense unless there's some other deal, unless there's something else that is going to go, that is going. So the next question that one really wants to answer, if you want, at least for me, if I want to make sense of this, is who are these guys and why are they doing this? Okay, so I'm just going to sketch out some possibilities. Okay, possibility number one is that there's some kind of implicit deal that from these buyers, that they will be compensated in the future by the bank in some way, right? In some way. This is, I think, the best, the story that I think that you want the authors of the paper want to tell. That is, yeah, here's a bunch of loans that are non-performing. If you buy this from me at face value, then it'll be okay with me if you were to not pay your loan to me in the future. So that I think that's sort of kind of your story. That it's sort of like, yeah, when these buyers buy the non-performing loan at face value, it takes it temporarily. It solves the balance sheet problem for the banks, but what it's giving rise to is future balance sheet problems. So the question is that the story? Story number two is that there is no hidden agreement, that the buyers do this because they want to maintain the relationship with the bank, okay? And a natural story that you can tell is that, well, the people or the companies that get access to loans from the banks, they get some rent from doing this because the loans are priced at below below market prices. Maybe that's a story. Okay, that strikes me as being a little bit more likely. That is, the bank officers go to these these companies or to these individuals and say that I've been really good to you in the past. I've given you all these subsidized loans. Now it's your turn to do me a favor. So let's think about, if that's the story, right? Then what does it mean for all the questions that you were asking? So the first question, when one wants to think about whether this is plausible, is to think, well, is the normal subsidy large enough for the firms, for these buyers to be willing to do this? And that's just a simple calculation. That is, you just need to do a simple calculation of how much is the subsidy involved in the access to loans from the bank, how much in loans are they getting, and how much above market clearing prices are these buyers paying for this loan. So maybe the subsidy is enough, but that's a calculation that I would like to see. But suppose that the answer to that is yes. Okay, what's going on is that a normal borrower gets access to these large rents from its relationship with the bank, and the bank is just calling in the favor. Okay, if that's the case, right, think about what that implies. Then what happens there is that then, well, the main thing that happens is that the allocation of rents from the subsidized loan changes. That is, who gets the rents from these subsidized loan changes. That is another way of thinking about this particular story, is that the rents of the companies or the people with access to loans, the rents are being taxed away to pay for the non-performing loan. So basically the bank is basically clawing back some of the free money that it's handing out to people. Or maybe the story is that these firms are making under the table payments to bank officials in order to get access to loans. Now, if that's a story, then the firm is not getting the rent. But now, if you also then in the future, then these firms are not going to be willing to make these under the table payments because it's no longer worth their while in order to make this. But the bottom line here, if you want to think about this, if you believe that this is the story, the non-performing loans are off the balance sheet of the bank. The non-performing loan are actually being fully resolved. Because it's no longer a liability of the bank. The toxic loan now belongs to the customer of the bank. It belongs to the customer bank, and then the bank isn't doing anything differently with the customer is just calling in the favor. Okay. The third scenario, right, is that maybe what's going on is that the people that are buying the toxic loans, these firms are owned by the same people as the owner of the bank. It's the same people, right? It's so maybe what's going on is that is that the owner of the bank, they're taking the non-performing loan, taking it from her left pocket and putting it in the right they're putting it in the right pocket. Now that if that's a story, right? If that's a story, and you know there may be something to the story, then you want to ask, well, if this one owner owns 100% of the bank and owns 100% of the buyer of the loan, then it doesn't matter, right? Then it doesn't matter. So now it could matter if they don't own 100% of it. If what's going on is that there's a bunch of possible investors, then it's still the case that if you put aside the possibility of tunneling, the non-performing loans are still off the balance sheet of the bank. Now, if there's tunneling, then you want to go back to the question of why do you want the non-performing loans off the balance sheet of the bank? I think the most powerful reason, at least to me, but I'm hoping that there's somebody in the audience that knows more about banking institutions than me. But at least to me, it's about transparency to the outside world. But then, if there's a possibility of tunneling, then it seems to me that there is a much bigger issue that a future investor has to worry about. That doesn't mean that this cannot be that this is not an issue, but it seems that there is something else. The last possibility that I thought of is that it could be the case that the buyers are forced by the local governments to pay back to buy the bad debt. That is nothing to do with the bank, but it's these local government officials that are basically saying, you know, the inspectors from the Central Inspection Department are coming. We've got to get these loans off the balance sheet of the banks. Do us a favor and do this and buy this loan. Think about what this is. This is exactly like a bailout, right? This scenario is exactly like a bailout, and the bailout is actually fully funded by firm-specific taxes. You know, the firms that are asked to do these favors, you know, they are getting taxed in order to pay to pay for the bailout. So then it looks exactly like the scenario of the Big Four, except that it did not occur through the AMC. It's almost as if what happened in the late 1990s was that the government went to a couple of firms that they had influence over, and they basically told these firms, you know, buy their loans from the Big Four banks, pay them at face value, or else. In welfare terms, it's exactly the same. That is, you know, somebody other than the banks, than the owner of the bank, paid for the resolution of the debt. But it's still the case that it's off the balance sheet of the banks. And I guess I would like to know which one of these four, maybe some combination of the four of the four stories is possibly the correct one, because we need to know this if we want to answer the ultimate question of, well, you know, what is the risk in the financial system? What's the health of what's the health of the financial system? So let me just end by saying that this is all contingent on the assumption that these really are non-performing loans. And then I don't really, and it looks and smells like these are not non-performing loans, non-performing loans, and this is what Michael was suggesting. So let me just turn my time over to the moderator.
Okay, so thanks a lot, Chang-Tai. Tianyue, would you like to give some quick responses? And then I will say a few words on this.
Thank you very much for the very insightful discussion. Let me first respond by saying why we think these are truly non-performing loans. So in our sample, the average delinquency, so basic is over 4 years. So this is deep in delinquency, international classification of non-performing loans. To give us some context, typically in like countries like US or European countries, any loan that is past due or delinquent for more than 90 days are classified as non-performing. So if it's 180 days, it's already deep in delinquency. So by using this metric, we think that these are non-performing, but these can still, this doesn't rule out that the possibility that the value of the collateral may increase in the future. For instance, if a piece of land is used as collateral, it can increase in the future and make the loan performing again. In our sample, about 1/3 of the loans are collateralized. The others are either guaranteed by a third-party guarantors or unsecured. So we think that a low fraction of collateralized loans means that any value appreciation of the collateral making the loans performing again in the future, this chance is rather low. Okay, so I think this is our response. And second, what's the intended objectives of this AMC? I'm glad that you point out HUARONG. HUARONG is one of the national AMCs that was set up in the late 1990s. And in recent years, it actually has become a financial conglomerate that does a little bit of everything. Its business is not just the typical business of AMCs, but also like insurance and securities and this and that, banking and so on and so forth. So however, I mean, compared to HUARONG, actually the local AMCs, their business are more simplified in structure because they are new creatures and they have not obtained these financial licenses. So their business or their operations are still pretty much aligned with their initial business description, which is taking over non-performing loans from banks, and they are supposed to resolve them outside of the banking sector. So I think these are the two pieces of response. And I fully agree with you on the point that why are third parties buying this, delinquent loans at such a high price? There must be some side deals to them. I want to point out that unfortunately we don't have the identity of these third-party borrowers, so this limits our analysis in certain ways. But among the 4 possible explanations you have proposed, I think that the last 2, the tunneling and the bailout forced by the local government, are unlikely to hold because these third-party borrowers, they are not state-owned enterprises. So they are typically private firms. And as you may know, that actually all the banks, they are state-owned in China. So there are very, very few pure private banks in China. Even the smaller banks, they are owned by local governments. So the ownership difference between the banks and these third-party borrowers who are private firms means that I think the tunneling in a traditional sense is unlikely to be the case. And the same argument goes to the last part, which is the government forces these third-party borrowers to bail out the banks. We think that if government wants to bail out, for instance, if local government wants to bail out these banks, they can actually use the local AMC, which is more direct. So in our paper, we have collected the ownership data of these local AMCs, not just our local AMC, but all the local AMCs. Their main owners are local governments or the direct SOEs of these local governments. So we believe that if bailout is indeed the objective of local governments, they can do so much directly or like a much much easily through the local AMCs themselves. So I think these are just my thoughts on this. As I said, we don't know the identity of the third-party borrowers, so we cannot precisely pinpoint which of the first or the second explanations you have proposed are more likely to hold. But we think that the third and the fourth explanations are less likely to be the case. So I think we can do some more in terms of the first two, which both like either the future loan forgiveness or just better access to loans from these banks. I think we can indeed do additional analysis and discussions on these two possible explanations. Thank you.
So thanks a lot, Tianyue. I can see quite a few people interested in your paper, but before go to the Q&A, let me first say a few words just to facilitate the following discussions. Going back to a few questions raised by Chang-Tai. By the way, first of all, I don't think my point is the non-performing loans in the paper are really not non-performing loans. My main point is the sample is not that representative. So think about what a typical local AMC is doing. So basically, by reading annual reports of HUARON and Xingda, the two largest AMCs, and also transaction level non-performing loan transactions from a small local AMC, which is Chongqing Yukang, I reached following conclusion. The type of transactions that the paper studied is a very special transaction. Say that haircut is almost like a zero. And for each transaction, you always get some premium from resale. It's like, the AMC is just charging commission fee. But this is a very special type of transaction. So like in Chinese, it's called 过桥业, bridging services. And what is the proportion of this kind of services in all the non-performing assets held by AMCs in China? My best estimate is just 10%. So a much bigger proportion of the business done AMC are actually dealing with resolution of non-performing loan they got from banks and other types of non-performing assets that they acquired from firms, in particular real estate firms. And if you ask me, what is the recovery rate of those non-performing assets, resolved by AMCs, and I would say it's between 30% to 40%. So that's a sort of the big picture about the industry in China. Chang-Tai, you want to say something, right?
Yeah, but then what you're saying, but it seems that what you're saying then is just another way of stating what Tianyue is saying, that basically some of the business of AMC is that they just serve as a pass-through entity. I mean, that's what you call the bridging services, right?
Yeah, but that's actually consistent with a point, she wants to make in her paper. That is, this is kind of a regulatory arbitrage. But, this part is kind of not the whole thing. It's not even the major part of AMCs. That's my reading of, yeah. Okay. Right. Okay, so let's take a few, go ahead, Chang-Tai. No. You want to add something? Okay, right. Zhiguo.
Yeah, related. It's very, very related. So what if the business model is basically holding on the loan and wait until some firms gets resolved through some restructuring? We know a lot of that kind of happen. Once you hit certain threshold of becoming a okay loan, some private party come in and they sell. So I was very interested in knowing your sample, how much of the loans that actually in the end didn't sell, staying at the balance sheet of the MC. That to me, that's a really crucial question in terms of whether the loans get sold, you interpret it as a whole sample, but actually shouldn't be. That's the first point. The second point, I think fundamentally, one one answer to Chang-Tai's question, why do people care so much about it, about these non-performing loans? Because investors, regulators, everybody are looking at it. It's just a financial statement, the first line of, so they want to do the book management. But I think the fundamentally that we care about it should be the incentive, because right, otherwise it's just the transfer. It's hold. Once you get a bad, you get out. All these things shouldn't matter. What I do know, yesterday I was chatting with a local Hanqing, local boss of the ABC agriculture. They really care about the non-performing loans in the sense that they feel like the manager or the loan officers are extremely concerned about whenever they got a non-performing loans, and therefore, the promotion chances, all these things gets hurt. So that I just want to make a point in the sense that maybe it's true that when the price is not reflected by the value, but the fact that the incentive system is not worked purely based on monetary, that the issue might not be that problematic of the whole, how these non-performing is the value is not reflected the true market value. Is this a big thing? Is it a bad thing? It's just something that it's not a very direct to me.
Okay, so thank you for the question. So let me first by saying that in our sample, only 10% of the packages still remain with the AMC. So more than 90% are sold. Some are like a small fraction in these 90% are tossed around to another AMC. But the majority of these are sold to third-party buyers who are borrowers of the banks. So I think in relationship to your question, also, I think Michael's suggestion of whether there's selection in terms of the AMC's treatment of the package, we can, I think, further test these different choices by the AMC, selling to a third party or keeping it longer, or versus selling to another AMC, whether any package level characteristics can be associated with this. Is it the case that AMC just keeps better package that with the eventual higher resolution value or recovery value by itself, and just sell the worst qualities to others? I think that's something we can definitely do in our analysis. And also, I think I just want to point out a little bit more on why people care about non-performing loans. Is actually one of the key things that the banking regulations targets. So as Zhiguo has mentioned, the banks cares about it because the regulators watches how they manage their non-performing loans. Also, the financial markets will care about this after they release financial statement. People would scrutinize their non-performing loans ratios and also other loan quality measures, and even to the loan officer level. So we have, I think, some anecdotal evidence that even the loan officers, their compensation schedule depends on, also crucially depends on, whether any loans they are in charge becomes non-performing. So it's at least in the context of a bank, it's something that even the bank managers cares, or all the way down to the loan officers. They also care about this. Yeah.
Let's take two more questions. I noticed. Sure. Bernie, you first, then Chang-Tai.
Yeah, I enjoyed the presentation and the discussions. There are two things in my mind. If there's tunneling, why would we need such complicated scheme to do the tunneling? So there has to be something to do with the incentive that lead to this complicated mechanism to tunnel. The second thing in my mind is like, if this AMC are owned by the local governments and so on, why do they have to sell them? I mean, they are not regulated just like banks. They are AMCs. If they lose the money, they bail out, write off. Then why do you do that? So I have just two questions. Why such complicated tunneling scheme? And second, if this AMCs are owned by the local government. It's a bailout thing. Why do they have to sell the NPL?
Okay, Chang-Tai.
Unless the NPLs are not NPL.
Yeah. Chang-Tai, go ahead.
So let me just say, my question about my question is not about whether why we care about non-performing loans. My question is, after the loan has been made, after the money has been spent, and after it already has become non-performing, why does it matter whether it sits in entity that bad loan sits in entity A or it sits in entity B? That's the question. That is, why is it important to dispose of the bad loan? The money has the money has been spent, right? The money has been spent already on a bad project. That's gone. That's gone. And then I'll come back to my analogy of the house. Suppose that I bought a house for $1 million. It's now worth $500,000. What difference does it make to my net assets whether I keep the house or whether I sell the house for $500,000 in cash? My net assets are exactly the same in one scenario. Now, the argument that you were making was that, yeah, I'd rather not have bought the house that fell in value, but that's a different question, right? That's a different. My quick answer to the one of the questions that Bernie asked is that it may be that the way, if it's a story of tunneling, and I have no evidence that it's tunneling, it's the issue that the other firm of the bank owner legally cannot directly buy the debt, that it has to go through legally. It has to, I'm speculating that legally it has to go through this AMC intermediary. So that's why it has to go. It has to be rerouted that way.
Sorry, would you mind to repeat that, Chang-Tai? Sorry, I missed something. Say it again, please.
There was a place in the paper where they said that AMCs are the only legal entities, or the only entities that are legally authorized to buy bad debt. Right. That was the statement. Now the question: suppose that I own the bank. Suppose that I own 100% of the bank, and then I own 50% of another company, and I want to screw over my partner. I want to send my bad debt over to this other firm and have the other firm pay face value. I legally can't do that directly because legally that other firm that I own can't buy the debt. It has to go through the AMC.
So
I'm speculating.
Right. So I think we're running out of time, but let me just say one last thing about this tunneling. So when I read the paper, I feel like the story is unlikely because in the paper they said that the buyers of non-performing loan packages are private firms. So I thought they know who are the buyers, and they can exclude the possibility the private firms or the buyers are somehow connected to the local governments through equity holdings. But yesterday I spoke with Tianyue, and she told me actually they do not know the third party's ID. So they only know which industry they are in and what kind of ownership is there. And then I feel like I'm more suspicious. I'm more suspectable about this tunneling thing because those things can be disguised by complicated ownership structure. So on that part, because Chang-Tai, I did the back of envelope calculation. It doesn't make sense for the third parties to buy those shitty assets. You're gonna require huge amount of discounts. It doesn't make any sense. So I think that's a more plausible explanation to me. But Tina, do you want to say something? It's just be very quick. We want to conclude.
Yeah, I think that as I previously chatted with you, since we don't know the exact ID, which firm is buying the third party borrower, we cannot rule out tunneling through a complicated ownership structure. because we only know that these buyers, is private firm by just 0-1 dummy classification. But since we don't know the ID, we cannot do, for instance, some of the work you have done, like tracing out the ownership structure of that. So I don't think we can fully rule out the tunneling. But I just want to maybe going back to some of earlier points. First of all, Chang-Tai is right in pointing out that legally, only AMCs can purchase NPLs directly from banks. If I'm a bank, I just want to tunnel and by selling it to my affiliated firm, which is not a legally AMC, I cannot do that. It's just outright forbidden not allowed by the law. Let me put it this way. And second, why is it necessary for banks why people think it's necessary for banks to dispose the non-performing loans? If I may maybe abuse a little bit of the cash analogy, it's because the business model or economic model of banks. So for banks that keeping a house is actually not very useful, because banks' business model or economic model is basically make loans, and then it doesn't actually use real assets in part of its production function. It needs to use cash or other highly liquid assets, financial assets to basically conduct its economic function. So for banks, we believe that basically there's a value in disposing the non-performing loans, and even recovering maybe 30 cents of the dollar can give them liquidity, which can allow them to again provide crucial credit to the real economy. I think the value lies there. If I think I just abused the cash analogy a little bit. So that's, I think, the value of disposing non-performing loan in a speedy way for banks. But I guess the question we want to cast is that banks seems to be relieved because their plate is cleaned, but the loans, at least in our sample, are still out there. We don't see much evidence of it being resolved. Would it be a problem of going forward? So I think that's the picture, the big picture question we want to throw there. As you have mentioned, there are still missing pieces that we currently don't have a definitive answer. But I think that I appreciate the discussions and the comments, which will be very helpful for us to further improve the paper.
Okay, thanks a lot. I would like to, formally conclude this webinar. Thanks again for everyone's participation in this extremely stimulating discussions. So, Bernie, do you want to say something for?
I want to thank Michael for doing a wonderful job in chairing Tianyue and Chang-Tai, and all these discussions increase our understanding of the problem and raise very, very useful future questions. Thank you very much. I want to thank the audience and the team for handling this. I'll thank the audience for all their participation too. I look forward to the next one, which is on July 29th. Hanqing Fang will present a paper on co-authored with others on the determinants of repos haircut, counterparty risk, and collateral risk. And so thank you very much. I want to see you again. I hope to see you again on July 29th. Thank you. And have a good day for those in Asia and good night for those in North America.
Thank you. Bye-bye.